In today's video, we are talking about loopholes for high-income professionals, how to slash your tax bill. I'm going to give a disclaimer. We are talking about legal strategies and legal loopholes that we can use to offset our taxes. Now, tax season, those two words that strike fear into the hearts of many. What if I told you it doesn't have to be that way? What if there were ways to legally reduce your, notice I always said legally reduce your tax burden? And these are strategies the IRS might not openly advertise, but that savvy investors and their accountants know all too well. Because the reality is the IRS is incentivizing us to do what they want by giving tax loopholes. But it's up to us to utilize them. If we don't utilize them and we pay taxes, then they may as well not even exist in the first place. And if your accountant isn't well versed in these type of strategies, then they may not present to you it as well. Well, that's what we're gonna try to change today. We're gonna try to stimulate some conversations with your accountant. This is not to be taken as any type of legal advice. Always consult your legal and tax and accounting professionals before making any tax moves. All right, again, another disclaimer. All right, guys, hey, everyone, welcome back to the channel. I'm Dr. Johnny Walker, aka Jonathan with Anachi. I'm an endodontist that has now gone to a comfortable part-time schedule. I now have tons of free time that I can do what I please, right? Where I can devote it to my family, raising our children, as well as doing things that I love to do, right? Pursuing my passions. One of my biggest passions is investing in real estate. And the second thing, I'm passionate about educating my fellow doctors about topics just like what we're going to talk about today. Today, I'm going to share some of those secrets with you. We are diving deep into the world of tax loopholes. Perfectly legal strategies that can help you slash your tax bill and keep more of your hard-earned money where it belongs, in your pocket. Well, literally, well, more so in your bank account, but you know what I mean. As high-income professionals, we work incredibly hard, right? Long hours, demanding patience, and the constant pressure to stay ahead. The last thing we need is to see a huge chunk of our income vanish come tax season to the government. But here's the good news. The tax code is complex, but it is also filled with opportunities. Opportunities to reduce your tax burden and consequently accelerate your journey to financial freedom. That's what this whole channel and brand is about. Because you don't, and this is the thing that a lot of people don't understand or get, but net income is how much money you keep. And the way that people say, hey, look, the way that I earn more money to spend is I gotta work more, work harder, grow my business more, which is true and it works. But if you're still paying higher and higher taxes, you're in a sort of a hamster wheel. At the same time, if you have strategies that reduce the tax liability, well, this also increases your net income, right? So it's not about what you make, it's about what you keep. All right, let's keep going on here. Now, if you are ready to stop overpaying Uncle Sam and you want to start building the wealth you deserve, stick around. The powers of compounding are destroyed by taxes. Wealth creation is destroyed by taxes. And we're about to unlock some serious tax saving potential. First things first, let's clear up some of the confusing jargon. We'll be talking about terms like depreciation, cost segregation, and passive losses. We've talked about this a long time ago in this channel. In this video, we're gonna go back and review a little bit so that you can understand what are loopholes that when we talk about the tax loopholes. Now, I know that for some of you, this might sound like foreign language, but don't worry, I'm gonna break them down in simple terms that you can understand. Now think of depreciation like a slow motion tax refund. It allows you to deduct a portion of the cost of an asset, like real estate, over several years, reducing your taxable income each year. It's a tax write-off, it's a loss that's not an actual loss, right? So this helps to offset your income. Now cost segregation is like turbocharging depreciation. It lets you break down a property into its component parts, like roof, floors, appliances. They all have different lifespans, and it allows you to depreciate them at accelerated rates, which results in even bigger tax savings in the early years of ownership. Now let's get back into the specifics, starting with the powerhouse of tax benefits in real estate depreciation. Now, the power of real estate depreciation is one of the most powerful tax benefits of real estate investing. It, like I said, allows you to deduct a portion of the cost of your property each year, even if the property is appreciating in value. So people think, hey, depreciation means it's going down. No, depreciation is an accounting loss, whereas appreciation is the value of the property going up, right? So you can have both happening concurrently. You can have the property increasing in value while you still have depreciation losses that you can take against taxable income, right? This can significantly reduce your taxable income, especially in the early years of ownership. And it gets even better. There's also bonus depreciation, which allows you to deduct a larger portion of the cost of your property in the first year. Now, this can be a game changer for accelerating your tax savings. Another strategy to supercharge your depreciation is cost segregation. This involves breaking down the cost of your property into its component parts, like the building structure, plumbing, electrical systems, and depreciating them at different rates. This can lead to even greater tax savings, especially for commercial properties like your dental practice. Retirement accounts. These are tax advantage havens, and if you're not using them, make sure you start using them. The one that we're beyond the common ones, such as IRAs or health savings plans, I'm going to talk about a less commonly talked about one called self-directed IRAs or SD IRAs. These are also somewhat equivalent to a solo 401k plan or a qualified retirement plan. But for the sake of this discussion, let's stay there equivalent. Now, these are also a game changer for doctors looking to save on taxes while growing their wealth. What's different, unlike traditional IRAs, SD IRAs allow investments in alternate assets like real estate, private equity, and syndications, Bitcoin, raw land, raw gold and silver. And these provide much more control of your investments as well as potentially higher returns. By investing through a tax-advantaged account, doctors can defer the taxes on the investment gains or even grow their investments completely tax-free depending on the account type. Now, this strategy not only diversifies portfolios, but also shields significant income from taxation, helping doctors keep more of what they earn while at the same time expanding the wealth in your retirement plan. The home office deduction is something I use personally, and that's why I'm talking about it. And this is making your home into a tax haven, right? For those of you who work from home, even if it's part-time, which is paying your bills and running your household, the home office deduction can be a significant tax break. If you use a portion of your home exclusively for business, you may be able to deduct a portion of your home expenses, such as mortgage interest, property taxes, utilities, and insurance for that purpose. Whereas if it was just your personal residence, you're taking the full of that as an expense with after-tax dollars. The next one I'm going to talk about is worth the time of you watching this video if you don't know about this already. And this is a huge one. Have you ever been told that you can't save much on taxes? Have you ever been told that you can't save that much on taxes with W-2 or 1099 income? Right? Or what about short-term capital gains taxes? Right? They're basically like, hey, look, there's minimal things you can do to shield it. And you're basically going to be paying taxes on a significant portion of your earned income, of your W-2 income. Now, I know I had a big problem with this. I was a very large W-2 and a 1099. I had both. I had large incomes in both. And when I went to my accountant, he told me the basic things that we always get told, hey, you can write off this, you can write off that, blah, blah, blah. But at the end of the day, my taxable income was still very high. And that income, you're told, hey, look, there's nothing you can do about it. Well, we have found a solution for that. Investing in the working interests of the oil and gas deal. We have just invested in a deal like this very recently in Colorado. We invested in 4 oil wells in the Niobrara Formation, and we have experienced this for ourselves and our investors. Now, when you invest in the oil and gas industry with a working interest, it's very important to have that distinction, because there are other investments that you invest in oil and gas where it's a non-working interest and this does not pertain. But with a working interest, you can offer substantial depreciation that directly offsets gains from your active income. You can actually take depreciation from an oil and gas investment, and there's significant depreciation, and you can directly offset your W-2 income. It's a game changer in terms of income taxes. The returns are actually quite lovely as well. All right, and the last one we're going to talk about today, and maybe you've heard of it, maybe you haven't. I know a lot of people have heard of it, but have never actually utilized it, is a 1031 exchange. Or, less commonly known and very powerful, maybe more powerful than the 1031 exchange, is a deferred sales trust. But they both allow you to do one thing, and they allow you to defer capital gains taxes on real estate gains. This is a powerful strategy for real estate investors, including passive real estate investors like what this channel is geared towards. Now, when you sell an investment property, you typically have to pay a capital gains tax on the profit. Depending on the state that you live in, it's between the 22 to 25% of the gains you have to pay as a capital gains tax. Now, capital gains tax is a lot lower than ordinary income tax. So here's how a 1031 exchange allows you to defer taxes: by reinvesting the proceeds into a similar property. This can be an absolute game changer for building wealth, especially if you're a real estate investor and growing your real estate portfolio. For example, we invest passively in a syndication style in multifamily real estate sometimes. Now, the gains on those, the profits from an investment like that, a syndication, they come back, and if the investor takes that profit, they say they invest $100,000 and they make another $100,000 over a 4-year period, and they get back a return of $200,000. Well, that $100,000 of profit is subject to capital gains, and again, we said let's say 25%. That means they would owe the government $25,000 of that $100,000 of profit. So the net to the investor would be $175,000, 100 being their first invested capital, plus $75,000 of after-tax dollars. Now that's a lot of money to some people, right? So they're like, hey, look, I don't want to pay taxes on this, and I can invest the proceeds into a similar property. So I can take the full $200,000 and invest it into another similar investment, another syndication, and now this allows your capital to keep working, but now you have the benefit of an extra $25,000 also earning. And this starts to get the compounding effect. So if you take that scenario where you invest $175,000 after taxes, or you've invested $200,000 by doing a 1031 exchange, do that one more cycle, right? If we double our money again, that $175,000 becomes $350,000. Pay the capital gains on the $175,000, which is about another $38,000. So now they're left with a net gain of roughly $315,000 after taxes. Right? Still pretty good. Starting from $100,000, you've tripled your money, 3x, to $315,000. Now take the same guy on the other side that has invested with a 1031 exchange. His $200,000 has become $400,000. So now we're starting to get a bigger gap, right? Through little over 300,000 to 400,000. Do it one more cycle, and then the numbers become even more stark. Then it becomes, after a third cycle, after paying capital gains tax, the first investor A, let's call him, after the third cycle, he has $525,000. Still an amazing return. He's 5x'd his money over a period of, say, 12 to 15 years. Whereas the guy that now has gone to $800,000, right? Because he's deferred the taxes. So when you look at the difference, $800,000 versus $525,000, you start to see the gap. And that's why it's so powerful to employ these. So if you do invest passively in real estate, which most of the guys, probably a lot of you watching this channel do try to take advantage of these 1031 exchanges, right? And keep perpetuating your wealth. But be warned, there are strict rules and timelines that must be followed in order to qualify for a 1031 exchange. And not all passive syndication investments allow you to go and take proceeds and go into a 1031 exchange. It depends completely on how the initial investment is set up, as well as the next investment that you have identified is set up as well. All right, guys, now I know this is a lot to take in, but the key takeaway is this. Tax planning is not just for the ultra wealthy. It is for anyone who wants to keep more of their hard-earned money and build a secure financial future. Now, I know the tax code is complex, but it's also your friend. Me saying the taxes are your friend? By understanding the rules and utilizing these legal loopholes, you can significantly reduce your tax burden and exponentially, thanks to this thing called compounding, accelerate your path to financial freedom. Now imagine what you would do with all that extra money that's coming in passively and you're building your wealth. Would you invest it in your practice? Would you pay off some debt? Would you buy that dream vacation home? Or maybe simply use the money to buy back your time and enjoy time with your loved ones? The possibilities are endless. So what are you waiting for? It's time to take control of your taxes and start building the life that you deserve and of your creation, not somebody else's dream. All right, guys, if you found this video helpful, hit that like button and subscribe to my channel for more wealth building strategies. And don't forget to join our Facebook group. It's called Financial Freedom for Dentists, where you can connect with over 2,000 like-minded dental professionals and get personalized guidance on your financial journey. If you're ready to take that first step towards investing and you're interested in learning more about how we do that and help doctors, head on over to walkofwealthcapital.com. That's W-A-L-K of wealth. And there we have a ton of resources to help you, including free webinars, ebooks, podcasts, downloadable resources, as well as investment opportunities tailored specifically for high-income professionals just like you. Action is the foundational key to all success. And if you are ready to take action, I invite you to schedule a call with myself or one of my helpful colleagues, which can also be done right on our website. Remember, your financial future is in your hands. So start taking action today. And until next time, keep investing in yourself and your dreams. I'm Dr. Johnny Walker.